Hey guys, Mike with Financeable here. It's Friday, which means it's time to answer the weekly challenge question. By the way, if you like these videos and find them helpful, definitely hit the like button down below and subscribe. We have a lot more coming. Let's hop in here. So this week we're looking at another accretion dilution question that's yield based. And with this question, we have company X buying company Y. Company Y trades at $35 a share and generates $1.75 a share in earnings. From a funding perspective though, company X is going to fund the deal with 30% debt at a 5% rate, 50% cash at a 2% rate, and then 20% equity, and they have a 25 times PE ratio. We're going to assume both companies have a 30% tax rate, and the goal is to figure out if this deal will be accretive or dilutive. So let's take a look. So we're going to start by working with the information that we have, and let's start with the target here, company Y. So we have $35 per share as an offer price. We have $1.75 of earnings per share. And so we have a price to earnings ratio of 20 times. Now again, we can flip price to earnings ratios and get to an implied yield. So we can take 1 divided by our PE ratio, and that's going to give us a 5% yield. So in effect, what this is saying is when we buy the equity of this company, we get a 5% return. And really the question is, how does that compare to the funding that the buyer is using to fund the deal, or the cost of that funding more specifically? So let's take a look here. On the left-hand side, we have the different types of funding that are going to be used to fund the deal, and we're going to work through the cost of each type of funding one by one. Let's start with debt. So we have a 5% pre-tax cost of debt and a 30% tax rate. But again, we have to remember that the true cost of debt is the after-tax cost of debt. So we're going to take the pre-tax cost of debt and multiply by 1 minus our tax rate. Now we can move on to the cost of cash, and it's a similar deal. We have a 2% cost of cash and a 30% tax rate, but we need to incorporate that tax rate into the cost of really foregone cash is a better way of putting it. And so what we're going to do is we're going to take the 2% cost of foregone cash, and we're going to multiply by 1 minus our tax rate here. And now we just have to calculate the cost of our equity. So the company, the buyer, has a 25 times PE ratio, and we can flip that PE ratio. We can take 1 divided by the PE ratio, and the equity cost of funding is 4%. So we now have the cost of funding for each of our sources of financing, and we can take a weighted average of those to get to our blended cost of funding. So down below, we're going to start with the weights for each of our sources of funding. So we have 30% debt, 50% cash, and 20% equity. And we're going to pull in the after-tax cost for each of these sources of funding from up above. So we'll pull in debt. We'll pull in cash as well. And then we're going to pull in equity. And I'm going to use a sum product function here to cross-multiply these out to get the weighted average. So we'll multiply the weights by the cost of each type of financing. And our blended cost of financing is 2.6%. So down below, we'll compare the 5% yield that we're going to generate with the purchase of the equity of the target to the 2.6% cost of funding. And when I sum that up, we're going to have a positive spread. So the answer to this week's question is that this deal is accretive, and quite a bit accretive. Now, the one thing I want to note here is you really didn't have to go through all this math to figure out if this thing is going to be accretive, or at least directionally accretive. So really quickly looking at the data here, we can say, okay, well, there's a 20 times PE for the target. So we flip that and get to a 5% yield. Let's see where the sources of funding are relative to 5%. Well, if I look at debt, it's 5%. We know after tax is going to be lower. Cash is 2%, so it's way lower. And then equity is going to be a 25 times PE ratio, so we're just under 5%. So all the sources of funding are going to be well below 5%. So without going through all the math, you can very quickly say, okay, this is probably going to be an accretive deal. So that's the shortcut that you could use to answer this question without going through the details, or you could go through the details like we just did. Either way, hopefully the way you'd answer this question makes a little bit more sense now. As always, thank you so much for taking the time to check out these videos and for participating in the questions. If you find these videos helpful, definitely hit the like button down below and subscribe. We have a lot more coming. Hope you have a nice weekend and take care.